Does paying off your mortgage lower your credit score? Hello and welcome to episode 7 of Money Anonymous. I'm Kira Jones, financial coach and founder of Financial Intervention Academy, here to answer your personal finance questions anonymously. And now on to today's question. Does paying off your mortgage lower your credit score? I know paying off a vehicle does, but assumed a piece of property wouldn't hurt. I want to pay off the house so I can buy a car, but it will change my strategy a bit if paying it off hits credit report in a negative way. Yes, it will lower your score temporarily, and here's why. This will affect credit mix and average age of credit history, so it could take a significant hit to your score. Because your mortgage will be one of your oldest debts that you have had the longest time. So when this goes away, if your average credit age isn't at least still 10 plus years, you will take an even bigger hit to your score. See in this example, when the mortgage goes away, it cuts the average age of accounts in half, where they once were over the 10 plus year average, but with the mortgage goes away, it's only 7 years of average credit history. Next category is affected the credit mix. This was once explained to me as the big five. That's mortgage, auto, student, major credit card, and store credit cards. So if when your mortgage goes away, you now might have only 3 or 4 out of the big five. Now, my obsession with the almighty debt score began around 2007 when a banker once told me to have one of each of the big five, pay them on time for 10 years without maxing out or your revolving credit, and you'll have an 800 plus score. Normally, my first question would be, why do you even need to have good credit? For you, it's to get the auto loan, in which case I would say go and purchase the vehicle before you pay off your mortgage, and you'll be fine, possibly for years, because your credit score only really matters when you're about to apply for credit. So when you get the car loan and the house is paid off, you shouldn't need access to credit for a long time, and thus can ease up worshiping the almighty debt score. But why do I say that? Well, that's because the most recent 6 months of your credit activity is the most important factor in credit scores. The most recent 6 months is more heavily scrutinized, so don't do anything else in this time frame, like apply for new lines of credit. If you need access to financing for something in the future, you can start working on your score about 6 to 12 months out from when you expect said loan or financing. I also want to address how you can best prepare for this auto loan. Do you know your current credit score? FICO score, not Vantage score, or do you even know the difference? Take a look at this graphic. Vantage scores, like the ones that Credit Karma uses, tends to run 20 to 40 points lower than your FICO scores that banks and most lenders use to approve or deny you. Vantage score models don't even have a category for very good like FICO does, but you want to know your FICO scores before you go and apply for an auto loan. So what score should you shoot for to get the best interest rates from lenders? A 750 score or higher should be enough to get you the best interest rates. If you're not at least in the 700s, here are some tips that could help get your score in a better shape before you go and apply. First, check and see how many hard inquiries you have on your report. Anything over 3 is too much. Since hard inquiries only stay on your report for 2 years, see how long it'll take for enough of these to fall off your report so that you have 3 or less. And here's a tip for everyone else out there. If you have 6 or more hard inquiries on your credit report, you can almost forget getting approved for anything from anyone. If you have balances on your credit cards, I would highly suggest you pay them down under 30% utilization for each card. Here's an example of credit utilization. Your credit card is a $1,000 limit and you have a balance of $700. That means you're using 70% of your available limit. And this is basically considered maxed out by creditors. So before applying for any kind of credit, it is ideal to pay all revolving cards down under the 30% utilization. While we're at it, what's your debt to income ratio? This will also play a huge part in the auto rates you could get approved for, or could determine if you get approved at all. You can have a great credit score, but horrible debt to income and not get approved. In which case, it might actually be better to a better move to wait and get your auto loan after you pay off your mortgage, freeing up your largest debt payment, and so your DTI should go way down. Here's how to calculate your DTI. Total up all monthly payments towards debt, divide that number by your total monthly pre-tax income, and that number as a percentage your debt to income. Anything over 50% and you won't likely get approved for anything, even if you have an 800 credit score. But I would shoot for a DTI of 42% or less before applying for financing of any kind. Brian from The Money Guy said it best. Cars are like financial napalm. They are a depreciating asset, and people should be more careful before taking out auto loans, especially with no money down. That is a recipe for winding up underwater on your car loan, meaning it's worth less than you owe on the darn loan. which is why I advocate what the Money Guys teach. I highly recommend all their content on YouTube. Take a look at this handy graphic here. For auto loans, you should absolutely put at least 20% down. I honestly feel this one is the most important of the three. Don't finance for any longer than 3 years, and don't pay more than 8% of your monthly gross income as a monthly car payment. So if you make $5,000 a month, you can afford a car payment of $400 a month or less. My last word of warning about car buying: I highly suggest that you buy something that is at least 3 years old. The auto market was pretty weird there for a couple years, but it's starting to go back to normal pricing. A 3-year-old car has already been hit by the hardest hitting depreciation. New cars lose about 20% of their value in the first year, and then lose about 15% of value each year thereafter. Another benefit to buying a 3-year-old car: you're more likely to know of any manufacturing issues and recalls for that make and model. Especially if it's a very first year for a new model. I'm looking at you, Ford Bronco. Brand new cars do not come out without their issues. And since cars are progressively more electronic, those issues are not only more expensive, but not always covered under warranty at Bronco. And lastly, a huge word of caution before you buy any sort of Kia or Hyundai. Right now, there is a huge social media trend about how to steal these cars. There are entire theft rings out there stealing Kias and Hyundais. And if theft wasn't enough, many insurance carriers are flat out refusing to insure these vehicles. I can't imagine going to a Kia Hyundai dealer and not only did the dealership not warn me about theft issues, but also didn't tell me that my insurance carrier might drop me because they refuse to insure certain makes and models. So I know that this is happening because my best friends own an insurance brokerage and they are hearing the horror stories constantly. It is getting a little bit better with the newer vehicles, but this is an example of how I might approach a situation with one of my clients, and I hope that helps you make the right decision for yourself. All right, folks, that is it for episode 7. If you would like to submit a question to be answered on a future episode, please fill out the anonymous Google form in the link in the description below. And we'll see you next week for episode 8 of Money Anonymous, where I talk about how to improve your credit score when you can't even get approved for a credit card or a personal loan. All right, disclaimer time. Every situation is unique and there is never just one right answer to questions about personal finance. Everything I discuss in today's video is meant for education and informational purposes only and should not be taken as financial advice. Even today's scenario is missing very important details that I would also figure out and discuss with a client before giving them a range of options so they're fully informed about their decision and their options, so they can make the right decision for them and their family. Thank you so much for tuning in. And if you found this helpful, since my channel is brand new, it'd help me out so very much if you gave me a like and a subscribe, and we will see you in the next one.